Hey everyone, so this morning we woke up to the news that Jeff Bezos is stepping down as CEO of Amazon Incorporated, which is huge news in the stock market world. So it is important that here on the channel today, we discuss everything that it means for Amazon shareholders, but more broadly, what does it mean when a founder steps down from the CEO position and how that should impact our decision making when looking at stocks to invest in the stock market. So first of all, let's just break down where we found out about this. So basically, Amazon this morning released their quarterly earnings for the fourth quarter and their full year earnings for 2020. And within that press release, they announced that Bezos would be stepping down as CEO. And before I go through and read you what Jeff Bezos said this morning when he stepped down as CEO, I do want to go through Amazon's full year 2020 earnings, at least some of the highlights, because that is also very important to what is happening this morning. So for the full year, net sales increased 38% to $386.1 billion, which was compared to $280.5 billion in 2019. Operating income came in at just under $23 billion, which was compared to $14.5 billion in 2019. Net income, so profit after all of their expenses after taxes, increased to $21.3 billion. On a per share basis, that equates to $41.83 per diluted share. And finally, profit as a cash flow figure, so free cash flow, increased to $31 billion for the last 12 months for 2020. And that was compared to $25.8 billion for the trailing 12 months of 2019. So Amazon continues to impress with incredible growth year over year, quarter after quarter. They are in stellar growth mode at the moment. But with that said, the stock is still trading at over an 80 price to earnings. So comparing the price of the business to the earnings that the business is producing, they're still well over between an 80 to 100 PE, which means that investors buying the stock today are still expecting growth of 50+% for many, many years more, just for the stock to break even over the next 5 to 10 years. If you want to see a full analysis of Amazon as a business as well as a long-term investment, then make sure you let me know down in the comment section below. In the press release, Jeff Bezos made a statement about him stepping down as CEO. He said, "Amazon is what it is because of invention. We do crazy things together and then make them normal. We pioneered customer reviews, one-click personalized recommendations, Prime's insanely fast shipping, just walk out shopping, the climate pledge, Kindle, Alexa, marketplace, infrastructure, cloud computing, career choice, and much more. If you do it right, a few years after surprising invention, the new things have become normal. People yawn. That yawn is the greatest compliment an inventor can receive. When you look at our financial results, what you're actually seeing is a long-run cumulative results of invention. Right now, I see Amazon as the most inventing ever, making it an optimal time to make this transition." So let's talk about what this means for Jeff Bezos and Amazon and what Jeff Bezos will now be doing. What was he doing previously, for those who are unaware, and what does this transition mean for what he does on a day-to-day basis, as well as the impact it has on the company. And before we jump into Jeff Bezos and Amazon specifically, it's important to understand how the top-level governance structure works in most public companies. In major corporations, there's two major bodies of governance that you need to understand. The first is the board of directors, and the second is the management team, or the team of executives. And in public companies that are large like Amazon and many other types of businesses, there will be significant overlap between these two, meaning there will be people who are both on the board of directors as well as a part of the executive management team. The board of directors are elected by shareholders and are responsible for setting the overall strategic direction of the company, as well as appointing the CEO, the chief executive officer. Essentially, the board of directors are elected representatives of the owners or the shareholders, and they sit right at the top of the company structure. The CEO or Chief Executive Officer is the head of the executive management team. They are the highest level employee of the company and are responsible for the day-to-day operations of the company and other high-level executives. Jeff Bezos is stepping down as CEO and moving in the third quarter of 2021 to become the executive chairman of the board. So what does that mean? Well, he's the chairman of the board, so he's the head of the board of directors who are the elected representatives of the shareholders who manage the management team, basically, or elect the management team. But he's also an executive chairman, which means he is still a part of the management team. And technically, the executive chairman reports in part to the CEO, but is also the boss of the CEO. So it's kind of a weird position. But in practice, Bezos will still likely be working day to day in Amazon. It's just that what he is doing is going to be different. He is likely going to spend more time focusing on innovation and inventions, and then basically advise the new CEO on how to implement those ideas into Amazon to grow the value of the business over time. And that's all well and good, but why does it matter? You might be wondering, does it really matter, and do we need to focus that much on management? And yes, it does matter, right? If you're following Warren Buffett's core investing principles, looking at the management team and the board of directors is one of the 4 key pillars in the investment process. And it makes perfect sense why we need to focus on management. And the reason why is because management makes a lot of top-level decisions that will ultimately impact how much cash we get back as investors, which is ultimately what we care about, right? We're outlaying money in exchange for ownership, a part ownership in the business. Let's say it's Amazon. And we expect that over time, we are delivered cash back that exceeds the amount that we outlaid, so that we make a positive return on that investment. And management's decisions will impact how much cash is returned to us. The best way to think about this is, imagine there are 2 companies. Imagine there's 2 Amazons, right? They have the exact same set of products and services. Everything is identical, except the management team in place. In one of the Amazons, in one parallel universe, you have Jeff Bezos and the founders of Amazon running the business and making decisions. And on the other side, you have some greedy, selfish executives who only care about earning their maximum compensation, and they're expecting to leave Amazon in a couple of years. If you watched and tracked those 2 businesses over time, even though they are selling the exact same products and services, they're the exact same business, they would produce different amounts of profit for shareholders, and those businesses would reach different levels of value. So whenever there is a change in the management team of a company we're interested in or we are invested in, we need to deeply analyze it to understand whether the change will have any negative or positive impacts on the profitability of that business over time. In this case, Bezos is remaining an executive, so he's not stepping back completely from the management team. It's just that his role is likely going to change, so it's difficult to see whether this would have any substantial negative or positive impact on the performance of Amazon in the next 5 years, for example. And whenever we're assessing management, that is often going to be the case. It's going to be almost always impossible to figure out whether it will be positive or negative immediately as soon as it happens. It's usually something you need to watch over a few years to see if the business continues to trend in a positive direction, as Jeff Bezos has built that company over the past couple of decades, or whether the business starts to degrade. And there actually are a couple of key metrics that we can focus on and watch over the next couple of years as an indication of whether the business is continuing to grow or whether it's starting to deteriorate. The first measure is the return on invested capital, and this is basically a measure of management's effectiveness at investing within the business. So how good are they at making investment decisions? In the same way that when you and I invest in a company, we get a certain rate of return on that over time. We can also assess management's internal investment decisions. For them, it's not buying stocks. For them, it will be, should we put $100 million into Amazon Web Services, or how can we develop that better, and assessing those impacts and those decisions. So looking at the return on invested capital and seeing if it continues to trend upward, stay stable, or decline over time can give us a really good insight into management's decisions. And the other metric that we can watch is the debt ratio. So making sure that the business isn't turning into one that relies on significant amounts of debts, because of course a business, as it grows its debts, if it decides to increase its debts, that results in an increased risk for us as shareholders and increased uncertainty as to whether we're going to make the return we expect in that business. And that's not something we want as investors. Rule number 1 of investing, according to Warren Buffett, is don't lose money. And that means investing in low debt companies that have a very low chance of completely erasing our investment. So that's something else we can track over time. In terms of my personal thoughts on this, it always kind of hurts me a little bit to see a company go from being a founder-run company to one that is no longer run or headed by the founder. If you look at my portfolio, every business in my portfolio was either a near founder-run company or is a founder-run company. Facebook is founder-run, Texas Roadhouse is founder-run, Corporate Travel Management is founder-run, and Thought Industries was founder-run up until a couple of years ago, and now the founder moved into an executive chair position in a similar way that Jeff Bezos is doing right now. And there's actually a number of reasons why I like founder-run companies. The main reason is that their businesses are usually run with passion, so nobody cares more about the long-term success of a business than the person who created it from the ground up. So you tend to see better management decision-making. The founders are usually also significant shareholders in the company, so values can be aligned between us as investors and them. They would, again, care deeply about seeing the business grow in value to its maximum potential over the long term, compared to a CEO who is just coming in and maybe isn't really all that passionate about the business and isn't financially impacted if the business doesn't go on to succeed massively. But of course, in most companies, we don't have a founder still running the company. So the second best thing is when there has been an immediate succession plan, like we're seeing with Jeff Bezos here, where Jeff Bezos is no longer the CEO, but he is still an executive within the company and will be advising the current CEO. And the current CEO is also not someone who is an outsider. It's not someone who is new to Amazon, which is very, very positive for the company. And I think that Amazon is going to continue to thrive, even though Jeff Bezos is no longer the CEO. But the new CEO is Andy Jassy. He joined Amazon in 1997. He actually founded Amazon Web Services in 2003 with a team of 57 people. And in 2016, he was appointed CEO of Amazon Web Services. So the new CEO has been in the company for over 2 decades, which is really, really good. And he also founded one of the most significant parts of Amazon's business going forward. So that is all very, very positive. The final thing that I like to look at in terms of the new CEO is, are they a shareholder? Do they own significant stock? And he does in this case. We can look to the proxy filing from last year and see that he holds 100,540 shares, which today is worth approximately $340 million. So the current CEO's wealth is significantly on the line, and it's aligned very well with shareholders, which means he cares about growing the value of the business long term, which is always a very, very good thing for shareholders. So what are your thoughts on what has happened today with Jeff Bezos and Amazon? I'd love to hear your thoughts down in the comment section below. If you enjoyed today's video, make sure you leave a like on it. And if you want to stay up to date with all stock market news and analysis and all kinds of things related to investing, then make sure you hit that subscribe button and join the team. But other than that, hope you guys have a great day, and I'll see you in the next video.